Welcome back, everyone. I am absolutely thrilled you're joining us for this explainer today, because we're diving into one of my all-time favorite concepts, manufacturing wealth. We aren't talking about just kicking back, buying a property, and crossing our fingers that the market magically drifts upwards. No way. We're talking about taking control and actively forcing value. Today, we're going to break down a practical, step-by-step playbook for forcing appreciation in real estate. So if you've ever wondered how the pros consistently generate outsized returns, literally regardless of what the broader economy is doing, well, you're in exactly the right place. Let's jump right in.
Okay, consider this real-world case study from Deko Capital. We're looking at a staggering jump from $900 to $1,600 a month in rent. I want you to really think about that for a second. We're talking about almost doubling the monthly revenue on a single unit. When you see numbers like this in the wild, it completely reframes your perspective on what's actually possible with a real estate investment.
That is a massive $700 per unit monthly rent increase. Just to put that into perspective, a typical run-of-the-mill annual rent bump, that might be, what, 20 or 30 bucks? So $700 is just in a completely different universe. And honestly, that begs a really important question for all of us here. Was this massive jump just pure luck? Did they just happen to buy in the exact right neighborhood right before some massive, unpredictable boom? Or is this a repeatable, step-by-step process that we can actually learn and apply ourselves? Well, spoiler alert, it is absolutely the latter.
So here's our playbook for today's explainer. First, we'll cover the power of value add. Second, step 1, identify the potential. Third, step 2, strategic execution. And finally, step 3, forced appreciation. All right, section 1, the power of value add. Moving right along into section 2. Step 1, identify the potential.
Now, the reason we're framing this whole Deko Capital story isn't just to celebrate one massive win, it's because it's essentially a masterclass in proactive investing. Because the hard truth is you can't add value if you don't buy the right canvas to begin with, right? You've got to know how to diagnose an underperforming asset before you spend a single dollar. Deko Capital's acquisition thesis was crystal clear from day one. Find an asset that is significantly underperforming its true market potential. They didn't just go out and buy a shiny, perfect building. They specifically targeted a property that was punching well below its weight class. They saw the gap between what the property was currently doing and what it actually could do.
So what are the actual symptoms you need to look out for? When you're out there, step-by-step diagnosing a property, here's the exact checklist to hunt for. Dated units, deferred maintenance, stagnant rents, like sitting at that $900 a month mark, and ultimately, unlocked upside. Now, to the untrained eye, dated units and deferred maintenance look like massive headaches. Honestly, they look like reasons to turn around and run away. But if you're playing by the value-add playbook, these aren't problems at all. They are massive opportunities cleverly disguised as problems.
Which brings us to section 3. Step 2, strategic execution. Okay, so you found that perfect, ugly duckling property. Now, we shift gears entirely into execution mode. Because identifying the upside is completely useless without the disciplined, step-by-step work required to actually capture it. And here is the golden rule of that execution phase. I really want you to let this sink in. Every single capital decision must maximize rent growth and long-term asset value. This means your renovations have to be treated as highly calculated strategic investments. It's not just random spending because you happen to really like the look of a certain type of countertop. If a dollar spent doesn't push the rent up or increase the building's overall value, that dollar simply does not get spent. Period.
So what does that strategic spending actually look like in the real world? Here is the exact step-by-step renovation procedure you want to follow. 1. Full interior renovations. 2. A hyper-specific focus on kitchen and bath upgrades. Because let's face it, these are the spaces tenants care about the absolute most. 3. Exterior improvements to immediately boost that curb appeal. And 4. Common area enhancements to really elevate the community feel. Notice how incredibly comprehensive this is? It's not just slapping on a quick coat of paint. It is a systematic overhaul targeting the absolute highest impact areas.
And the source material from Deko Capital explicitly validates this approach. They relied on those exact 4 core pillars for their capital improvements: interiors, kitchens and baths, exteriors, and common areas. Listen, if you want a massive jump in your returns, comprehensive execution across the entire property is absolutely non-negotiable. You have to commit to the full procedure. All right, let's hit section 4. Step 3, forced appreciation. This is it, the ultimate payoff. Let's define this concept explicitly so we can really grasp the massive economic result of this strategy we just walked through. Forced appreciation is increasing the value of a property through proactive, operational improvements rather than passively relying on market trends. It means you are 100% in the driver's seat. The math in commercial real estate basically dictates that property value is a direct multiple of the income it generates. So if you proactively force that income up, you forcefully push the value up with it.
Let's put these two mindsets side by side. On the left, we have passive luck. That's simply hoping for a market rally and crossing your fingers for favorable timing. It's stressful, it's risky, and frankly, it is totally out of your control. On the right, we have active growth, relying on operational performance and strategic renovation. This is a controlled, deliberate, and powerful process where your actual hard work directly translates into increased equity.
Because here's the reality. Value is created through operational performance, not a market rally, not favorable timing. This is the massive mindset shift required to really crush it in this space. You aren't just a speculator throwing darts at a board. You are an operator.
And guys, this is the ultimate validation of that operator mindset. After all the careful identification and the incredibly disciplined strategic execution, those post-renovation rents hit $1,600 a month. That $700 increase we talked about at the beginning, it was driven entirely by strategic renovation and disciplined execution. Zero luck, just pure unadulterated strategy.
It really comes down to Deko Capital's rallying cry, "This is the work." And it's a great reality check. Real estate wealth is actively manufactured through operational excellence. It takes elbow grease, it takes strict adherence to a step-by-step strategic playbook, and it takes flawless execution. It's not some get-rich-quick scheme, you know? It's a get-wealthy-through-work reality.
So, I'll leave you with this to chew on as we wrap up today's explainer. In your own financial journey, are you relying on lucky market timing, or are you ready to roll up your sleeves and force appreciation through operational performance? The playbook is right here. Now it's completely up to you to apply it. Thank you so much for joining me, and as always, keep learning.